It's time again for a session of financial reporting. So this is a CPA Dunojoi. I always do sessions on financial reporting and advanced financial reporting. And in other than financial reporting and advanced financial reporting, in partnership with other guys who will ensure that we have covered the entire content of CPA. So for today, I would like to look at the question which was tested in financial reporting, that is intermediate level, the question concerning consolidation. So which areas you are most likely to know in order for you to tackle the question up to, let's say, 80% as a student. So the question said on 1st April 2021, RISIC Limited acquired 75% of the equity shares of Sarama when the retained earnings of Sarama Limited stood at 234 million. The acquisition consideration consisted of cash amounting to 510 and a share exchange on the basis of 2 ordinary shares of RISIC Limited for every 3 ordinary shares acquired in Sarama Limited. The market value of RISIC Limited's shares as at 1st April 2021 was shillings 16 per share. No accounting entries have been made in respect of the share exchange consideration. So on this scenario, you were required to use this share exchange in order to determine the purchase consideration beside the cash which was provided there. Then you can be able to see there is a draft statement of financial position for the 2 companies, that is RISIC Limited and Sarama Limited. So you are given non-current assets, you are given current assets, you are given equities and liabilities, and the non-current liabilities. So remember that for the question of consolidation, other than being provided with the relevant statements, that is maybe income statement, statement of financial position, you will be given an additional information. And this additional information is the one, if you are capable of understanding its interpretation, you will be able to do the question fully. So the additional information says that the fair value of Sarama Limited's net assets approximated their carrying amount with the exemption of a specialized piece of equipment, that is with a specialized piece of equipment which had a fair value of 120 million in excess of its carrying amount. This equipment had a 10-year remaining useful life on 1st April 2021. So right now, what are they talking about in this additional information number 1? So because now they have said that the fair value of Sarama Limited's net assets approximated their carrying amount. So there's something we call revaluation of assets. So there's something we call revaluation of assets. So when we talk about the revaluation of assets, this revaluation is the difference between, so revaluation is the difference between the carrying amount of an asset, that is the carrying amount of an asset. So the carrying amount is the same as net book value, and its fair value, So the difference between the carrying amount of an asset and its fair value, of which you will find that the fair value is obviously higher. The fair value is higher than the carrying amount. Is higher than the carrying amount. Is higher than the carrying amount. So the examiner can test revaluation in 3 different ways. So the first way is whereby it will provide the fair value and it will provide the carrying amount. So what you do, you take the difference. The second thing you will be able to provide is by saying that the fair value is in excess of the carrying amount by a certain amount. Or you can be able to say that the carrying amount is below the fair value by a certain amount. So the first scenario I've said is whereby you are provided with a fair value and you are provided with a carrying amount. You take the difference. The second scenario is whereby the examiner will be able to say that the fair value is in excess of the carrying amount by a certain figure. So that is the revaluation, which would be provided direct. Or the third scenario is whereby you are told the carrying amount is below the fair value. The carrying amount is below the fair value. So those three scenarios, the examiner will be talking about revaluation. Like now in our question here, the additional information number 1, the examiner said that the fair value of Sarama Limited's net asset approximated their carrying amount, with the exception of a specialized piece of equipment which had a fair value of 120 in excess. So you can see now the fair value was in excess of the carrying amount. So this fair value is in excess of the carrying amount by 120. So that is what we call revaluation. So with revaluation gain, you are supposed to debit the PPE account, the property, plant and equipment account, then you credit the revaluation reserve account. The revaluation reserve account. So that is what was required in information number 1. Additional information number 2, that it's the group's policy to value the non-controlling interest fair value as at the date of acquisition. The fair value of interest in remittance on 1st April 2021 was estimated at 144 million. So remember that there is something called goodwill according to IFRS 3. According to International Financial Reporting Standards 3, we have something called goodwill. So goodwill is all about the economic benefit expected from an asset. The economic benefit expected from an asset, and you cannot be able to differentiate. You cannot be able to separate, that is, the goodwill itself from the asset. You cannot be able to separate the two. So, in a question whereby you find, for example, the parent has acquired a subsidiary, remember that this parent must compute the goodwill of this subsidiary. But in the computation of the goodwill of this subsidiary, there are methods which are supposed to be used. So we have two methods which the parent can use, but not both methods can be used at the same time. So the first method being the fair value method, the next method being the partial method. So for the parent company to use the full method in the computation of the goodwill of the subsidiary, you must be provided the value of the non-controlling interest. So there will be a statement in the additional information saying that the controlling interest was made at its fair value, so of which you would be provided a figure concerning that. So being given that one, you would be able to use full method in the computation of goodwill, of which NCI would be able to receive something from the goodwill, be able to compute, and at the same time there would be something attributable to the parent. And that is what was provided in the additional information number 2, of which you were told that it's the group's policy to value the non-controlling interest at fair value as at the date of acquisition. The fair value of the non-controlling interest in Sarama Limited on 1st April 2021 was estimated at 144 million. Number 3, during the year to 31st March 2022, Sarama Limited sold goods to Receipt Limited for 64 million, earning a gross margin of 25% on the sale. Receipt Limited still held shillings 48 million worth of these goods in the inventory as at 31st March 2022. So, When you hear a statement of this kind, there is something we call unrealized profit, unrealized profit on stock, unrealized profit on stock, the UPS. So this is whereby you find that, for example, the parent had sold goods to the subsidiary at a profit, but the subsidiary has not sold all of these goods by the end of the year. So there's some percentage, there's a small percentage of the goods which the subsidiary received from the parent, which are unsold by the end of the year. Like now, in this additional information number 3, you are told that Sarama is the one who sold goods to Risiki at 64 million, of which when Sarama was selling these goods, he included a gross margin of 25% on the sale. But now we need to check in the books of Risiki. Did Risiki resell all the goods he received from Sarama by the end of the year? So of which you are told that Risiki Limited still held 48 million worth of these goods in the inventory as at 31st March 2022. So based on this additional information number 3, you are supposed to do this unrealized profit on stock, of which you take the unsold goods times the profit margin, unsold goods times the profit margin. So right now the unsold goods is 48, the profit margin is 25%. Then since it was due to upstream sale, because now Sarama is a subsidiary and Risiki is the parent, since it's the subsidiary which was selling to the parent, remember that profit is overstated in the subsidiary. The profit which was never realized by Risiki is overstated in Sarama. So we need to avoid profit overstatement by eliminating that profit in the books of Sarama by doing what? Debiting the retained earnings. We debit the non-controlling interest account, and at the same time we credit the inventory account. So that is what was required in the additional information number 3. So the additional information number 4, and I think this was a bit tricky area to most of the students because that one was the statement which was supposed to answer the additional information number 1 containing 3 marks. So they said that on 1st April 2021, Risiki Limited also acquired a 30% equity interest in Amua Limited. So this is another company which has been acquired. This is an investee company which has been acquired, of which when the parent acquires another investee company, up to 30%, we call it an associate, of which you know that if it's at 50%, it's called a joint venture. And if it lies, that is, if it lies at the percentage of 51 to 100, it's called a subsidiary. So the 30% interest which was acquired in Amua, so makes Amua to be an associate to the parent. So of which you are told that on 1st April 2021, Risiki Limited also acquired a 30% equity interest in Amua Limited for 65 million in cash. Amua Limited sustained heavy losses over the last few years, and Risiki Limited hoped it could turn in around through its significant influence over Amua Limited. So in the year ended 31st March 2022, Amua Limited made a loss of 150. Number 5, impairment test performed on 31st March 2022 revealed that the investment in Amua Limited had been impaired by 5 million due to sustained trading losses. However, no impairment was required in the respect of the goodwill arising on acquisition of Sarama Limited. So they require you to do the value of investment in Amua, calculate value of goodwill. So that first 2 requirements, those 6 marks, you were supposed to do them very fast because they were very direct. Then number 3, they were in need of consolidated statement of financial position. So let us do this question so that once you have interpreted the question as a student, it's always easier for you now to do the remaining areas. So let me now present the way you are required to do in that exam, even if you are waiting for the results to be released. So determine the value of investment in Amua. So we have said that Amua is an associate. Amua is an associate. Amua is an associate. And when the parent is accounting for the associate, is supposed to use a method called equity. So equity method. Equity method. So whereby this Amua will be recognized with its initial cost of investment. Initial cost of investment. Then you are supposed to add the share of post-acquisition, the share of post-acquisition profit or loss, the share of post-acquisition profit or loss. So the share of post-acquisition profit, the share of post-acquisition profit. So if it's profit, you add. If it's loss, you are supposed to deduct. So that is it. So then you raise impairment. You raise impairment loss. You raise impairment loss. So on this scenario, this additional information number 4 is the one which was supposed to answer this requirement number 1. You were given the amount which was paid when RISIC acquired Amua, which was 65 million. So I can say here, shillings in thousands. So this is 65,000. Then checking on this question, you were told that in the year ended 31st March 2022, Amua Limited made a loss of 150. He made a loss of 150. And you are told that impairment test, that is additional information number 5, impairment test performed on 31st March 2022 revealed that the investment in Amua Limited had been impaired by 5 million. So we have 5,000 here. Then on the other side here, you say 30% of the 150,000. So the 30% of 150,000. So let's check the answer. So that is around, so 0.3 times 150,000. So this is 45,000. So since this was a loss, the 150,000 was a loss, I will not be able to add, but I will deduct this one. Then I will be able to raise the impairment loss. I will be able to raise the impairment loss. So if I take 65 minus 45 minus 5, that is 15,000. So that one, you get net investment. You get your net investment. You have your 3 marks. The next thing which was required is all about goodwill. The next thing which was required is all about goodwill, of which we always say that goodwill is all about the purchase consideration. The purchase consideration minus the share of net assets acquired. The purchase consideration minus the share of net assets acquired. Net assets acquired. The share of net assets acquired. So, remember that on this scenario, I will be required to do the goodwill using the full method. I have already explained that. Why am I using the full method? Why am I going to use the full method? Because the NCI has been measured at its fair value. So you start from the purchase consideration. You start from the purchase consideration. You start from the purchase consideration, of which now the purchase consideration was never provided direct. So that is the first working I could have done to determine the purchase consideration. So they said that in the determination of the purchase consideration, they never provided this one direct. But at the start of the question, there's a sentence there, they said, the acquisition consideration consisted of cash amounting to 510. So we have cash amounting to 510 million, so I can say in thousands. Then, after that, they talked about exchange of shares. They said, and the share exchange of 2 ordinary shares is seeking. So share exchange. So these are share exchange. These are share exchange. So the share exchange, whereby they say that 2 ordinary shares, so the 2 ordinary shares, so that is so 2 ordinary shares in Riziki, for what? For 3 ordinary shares in Sarama, 3 ordinary shares in S. So remember that Sarama is the one which was acquired. So we need to check the share capital in Sarama. So go to the statement of financial position. So the link was in that video. Check down there once be able to see the relevant question attached. So on this case, the share capital of S, that is Sarama, is 300,000. So that is 300,000, but 300,000 is in terms of shillings, of which per share was shillings 10. So to get the number of shares, we divide. So we have 30,000 shares. So of which the parent, which is Risiki, acquired 75% of this. 75%. So what we do here, we do this. So we say 75%, 0.75. So 0.75 times 30,000. Times 30,000. So that is 22. So this is 22,500 times 2. Because we are doing a cross multiplication. So times 2 divided by 3. So we need to check how many shares did Risiki acquired in S. So what we do there is all about, we say 22,500 times 2. So times 2. We divide by 3. So we get 15,000. We get the 15,000. So we get the 15,000. So we get the 15,000. So that is the number of shares. So those are the number of shares. Those are the number of shares. So those are the number of shares which Risiki acquired in Sarama. But the determination of these, in the final determination of the purchase consideration, so I will be able to say, so my ordinary share capital will be, so I will take the 15,000 times the par value. So that is 150,000. Then I would say 15,000 times what? So there's a share premium. And how is this share premium arising? So if you check in that start of the question, they said that the market value of Receipt Limited shares on 1st April 2022 was 16. But remember, the par value was 10. So if they could have been issuing shares at 16, and we know the par value is 10, they are realizing an extra amount by 6, that is 6 shillings per share. So the excess, so the market value is 16, of which the par value is 10. So we have an excess amount they could have realized of shillings, that is 6. So that is what we call the share premium. So the share premium. So we take 15 times 6. 15 times 6. That is 90,000. So then we'll be able to get the total. So 150 plus, so we take 150 plus 90, that is 240,000. So 240,000 is our purchase consideration. So after that, I can be able to do goodwill by saying that purchase consideration is all about 240, of which the fair value of NCI, because now I'm using the full method, that is why I have introduced another column here for NCI, and this one is for the parent. So the fair value of NCI was provided in addition information number 2. I think it was 144. Yes, that is correct. So this is 144,000. Then after that, we raise the net assets. Share of net assets. Share of net assets. So the share of net assets, we have a equity component, that is the ordinary share capital. We check in the statement of financial position. So whereby the ordinary share capital is 300,000. So that is, so we say 75% and 25% of 300,000. Then we have another item there called retained earnings, of which you need to be careful about retained earnings, because the figure you are supposed to use for retained earnings when doing your goodwill is all about the figure as acquisition date, as at the time that subsidiary was acquired. So you say 75% and 25% of the retained earnings as at acquisition. So remember that Sarama was acquired on 1st April 2021, when the retained earnings was 234. That is provided at the start of the question. So that is 234,000. 234,000. Then the next thing, which was a present, is all about the revaluation. The revaluation reserve. So I would say 75% and 25% of. So the revaluation reserve is the one which is under additional information number 1, whereby the fair value was in excess of, the carrying amount by 120,000. And that occurred as at the date of acquisition, of which even the revaluation reserve, the figure must be as at the acquisition date of the relevant subsidiary. So the figure there I have said is 120,000. So we can be able to share. Let us use our calculator. So by saying that 0.75 times 300,000 times 300,000, that is 225,000. Then if I say minus 300,000, so this is supposed to be 75,000. So these ones are deducted. Then 0.75 times 234,000. So this is all about 175,500. 175,500. So 25% of 234. So 234. So this is 58,500. Then the last one, 0.75. You multiply with 120,000. So that is 90,000. So that is 90,000. Then 25% of the same is 30,000. let us deduct the net assets from the purchase consideration and at the same time from the fair value of NCI. But there is a small change which we have to do here, of which the purchase consideration is not just the 240, but remember there was this cash. There was this cash which was provided there. So I have to add the cash, which is 200, that is 510, which is 510 plus 240, so that is 750. So this one is supposed to be 750,000. Because remember that other than through share exchange, which we determined an amount of 240,000, there was cash which was provided by Risiki, so which we needed to add with the 240 to get the 750,000. So that from there now we can continue and deduct our net assets from the purchase consideration and from the fair value of NCI. From the fair value of NCI. So let us use our calculator here. So we say this. So 750,000 minus 225,000 minus 175, 500 minus 90,000 minus the 90,000. So that is around 259. So that is 259 because I've taken 750,000 minus 225 minus 175, 500 minus 90,000. So this is 259, 500. And then the next thing is all about 144,000. 144,000 minus 75,000 minus 58,500 minus 30,000 minus 30,000. So this is 19,500, but it's a negative. So goodwill. So what you do here to get the total goodwill, we need to do a summation. So which means that I would take 259,500 minus the 19,500. So this is the 240,000. So the 240,000 is our total goodwill. So this is our total goodwill. So this is our total goodwill. So after we are done with the second requirement, so up to this point we have 6 marks. So we have 6 marks. So let us do the last part of this question, which is having 8 marks. So the presentation now of the statement of financial position. The presentation of the statement of financial position. So for the presentation of the statement of financial position, it's very easy because now we have, it's just Risiki, which is the parent, which is consolidating just one subsidiary. It's consolidating one subsidiary. So consolidated statement of financial position. Statement of financial position. Statement of financial position as at. So that is as at 31st March 2022. 31st March 2022. So what we do, we start from the non-current assets, the way the statement has been provided in that question of yours. So the current assets. So the non-current assets. So the non-current assets, we have the PPE, property, plant and equipment. So the property, plant and equipment, we have 15 million 95,300 plus the subsidiary, which is 636,400. So remember that under this PPE, I said we are supposed to add the revaluation, of which we have the revaluation of 120,000. Due to revaluation, remember that there is obvious what we call depreciation undercharge, because that figure for revaluation has not been subjected to depreciation. So there's a depreciation under the 120,000, which has not been deducted anywhere. So we need to determine the depreciation under the 120. So which I will take the 120,000, I multiply with the rate, or I divide with the remaining life. So the equipment has a 10-year remaining life. So we have 10, so we divide. So here I am supposed to minus 12,000. So there's nothing else to adjust, of which if there was something we call UPFA, I could have done what? Deducted, and here is profit on fixed asset plus depreciation overcharge, I add back. So to understand this UPFA and the depreciation overcharge, you can be able to check on my other questions which I have done. Or you can be able to check on the upcoming videos. I will be able to cover the UPFA and the depreciation overcharge. So the next thing is all about, we have investment, but investment in subsidiaries replaced by goodwill, of which goodwill in this question of ours, remember that we did that one as a requirement, it was 240. So that is investment in Sarama. Remember there was Amur, of which we did the investment in Amur, using the equity method. And it was requirement number 1, we got 15,000. Then another thing to do is all about current assets. Current assets. So for the current assets, we talk about inventory. So 165,000 plus what? Plus the 160 for the subsidiary. We minus the UPS. We add the goods in transit. So UPS is all about unsold goods, of which if you go to additional information number 3, the unsold goods there, the unsold goods was 34. So because they say during the year, Sarama sold goods to Risik at 64, earning a gross profit of 25%. So Risik still held 48, so it's 48 million worth of these goods. So 48 is the unsold goods. I explained on the same. So we take the unsold goods, there's a profit margin. So the profit margin is 25%. The profit margin is 25%. So which means that 48 times 25 times 0.25. So that is 12. So 12,000, that is the UPS you minus. And if there was goods in transit, we need to record them, because by the end of the year they were in transit. So we debit the inventory account and we credit the payables account. So after that we have the receivables. So for the receivables, I will talk about 247. So 247, 100 plus 107, 800. 107, 800. So you are supposed to deduct intergroup owings. The intergroup owings and the cash in transit. Because now for the intergroup owings, we need to disregard that amount by crediting the receivables and we debit the payables. For the cash in transit, we need to record that cash by debiting cash or bank and we credit the receivables. So which we were told that in the additional information number 3 down there, Sarama Limited still had the full invoice of 64. in the trade receivables as at 31st March 2022. However, receipt trade payables only showed 34. So which means that the balance, which is 30, has already been paid. Because the total was 64, but the trade payables of Risiki showed 34. So the total was 64, but the trade payables of Risiki showed 34. So the difference of 30 has been paid. So which means that the outstanding balance is 34, which is the owings. The 30, so this is 34,000 and the 30,000. So the 30,000 was in cash in transit. So this 34, I would be able to deduct it under the payables in order to disregard. Then the 30 I would be able to record by debiting under cash. So of which I would be able to say bank. I would be able to say bank. So we have the 21,000 plus 13,800. So I add the 30,000. So up to that point, I would be able to get total assets. I would be able to get the total assets. Then I will move to equity and liabilities. Equity and liabilities. So for the equities and liabilities, remember that there is this aspect of ordinary share capital. So you use the one for the parent. We use the one for the parent. So 850,000. But I will be able to add the 150,000, the one which was due to the share of exchange when the parent was acquiring the subsidiary. Remember, we did that working. Then after that, we have the retained earnings. This one needs a working. Then there was share premium. There was share premium of 90,000. There was a share premium of 90,000. This one again is due to share exchange. This one was due to share exchange. The one we did as a working when determining the purchase consideration. Then after that, we can go ahead and do the 8% debentures. 8% debentures. So the 8% debentures is 460,000 plus the 40,000. Then the next thing is all about current liabilities. Under current liabilities, we have the payables. We have the payables. Or with the payables, I would be able to check 460,000. 460,000 plus the 40,000. So I would be able to minus the intergroup owings, which was 34, in order to disregard that. And if there was goods in transit, GIT, I could have recorded there the goods in transit. So by adding, the same amount is added under inventory. So current tax payable, current tax payable. So for the current tax payable, we talk about 108,000 plus 52,800. So the only thing I never included here is the non-controlling interest, the NCI, to determine the capital of the minority shareholders. So this one needs a working. So the only two workings which are required here is for the retained earnings and the non-controlling interest. But even without those workings, you have your 8 marks. Because if you do the computation for PP, you have your mark. So you will be able to use your calculator to get the figure at the end there. Then goodwill, you have this, you have this. For inventory, you have another one. This one is another one. That is another one. So 1, 2, 3, 4, 5, 6. For ordinary share capital, that is another one. That is 7, 8, 9, 10, 11. This is more than even 8 marks. Even required to do. So it was just a wastage of time to do these two workings for the retained earnings and the non-controlling interest. Because already the entries we have, they are enough for the 8 marks. So as students, you are highly welcomed to the CPA do not show online classes, so whereby we do classes through the Zoom platform for the financial reporting and advanced financial reporting, and in other areas of CPA in partnership with my fellow colleagues. So you can be able to call through the number 0728 760 546, or you can check in my social media platforms, that is CPA do not show, so that you communicate on the same. All the best in your upcoming results for CPA, as I hope to see you in my online classes coming next week. Have a great time. Thank you.